So you want to start investing, but you're scared. You don't want to put all this money into investing and all of a sudden have $0 in your account. You're scared, you're confused, and you don't know what to do. But in today's video, I'm going to be going over 5 mistakes you can avoid when starting investing. And if you stick to the end, I'm going to throw in a bonus one. So the first mistake that you're going to want to avoid when you actually start investing is waiting until you know it all to actually start investing. I know that seems kind of silly to say, but a lot of people will sit on the sidelines trying to figure out the exact way to invest to get the biggest return and wait until, let's see, when the best opportunity is to buy, or once I have this figured out, I will actually invest. But in reality, that's not a good way to start investing. The best way to start investing is to do a little research and then actually just dive in. Get your feet wet and actually start investing, because when you start investing, the longer you are in the market, the better your returns are over time. Plus, the biggest thing is you don't have money sitting to the side where inflation every year is just eating it up. And inflation is basically when the dollar value that you have actually goes down. So every year on average, inflation is around 2.5%, meaning that if you have $100 that's sitting in your bank account and you get 0% interest on that or 0 return, it's actually going to be worth $97.50 the next year. So if you actually get into the market and then start gaining returns, you'll outpace inflation, meaning that your value actually goes up and purchasing power goes up because your dollar is actually gaining value and keeping ahead of that inflation. So don't wait too long to invest and just start. Mistake number 2 that I see a lot of people make is they actually start investing before they have a savings. And what I mean by this is you're supposed to have an emergency fund so that you can pay all your bills. Even if you have no income coming through the door, you will be able to pay your bills and not have to pull from your investment accounts and actually hurt your investment accounts in the long run. A normal emergency fund is going to have 3 to 6 months worth of expenses. So if it takes you $3,000 every single month, you should have about $9,000 saved up in a savings account so that if something does happen, you're not pulling from your investment accounts. Now, I know everyone's different, and some people, they're okay with having 0 emergency fund and they just want to invest, which is awesome if that's for you, but that's not how I see it. I see it as, let me have a little stack of cash to the side so that if I do have an emergency, if I have no income coming through the door, or if I just have a bad time, maybe the economy crashes and I get laid off, or I have so many bills and I can't keep up, then I have an emergency fund where I can pull from and not have to actually touch my investments, hurting my return in the long run. Investing is not meant to be buy and sell all the time, constantly, month over month, week over week, because when you're investing, you're in it for the long time. If you're in it for trading, that's completely different. That's when you're buying and selling all the time to try to make money through the markets. But when you're investing, you're periodically investing money for the long horizon time so that it will compound over time like a snowball rolling down the hill. And that's why we want an emergency fund set to the side so that whenever we do start investing, we don't have to actually pull from the investment account to make ends meet. The third mistake you want to avoid when you start investing is to actually invest too much money. And what I mean by this is some people aren't mentally stable enough to invest a bunch of money and watch the volatility in the market. Sometimes you have to ease in, get your foot wet, really learn how the market is before you take a dive into the pool. Maybe you have to enter the shallow side before you actually get to go jump off the high dive. You know what I mean? And so when I say this, I don't think that some people are actually mentally prepared to see $10,000 in an account go down to $9,000 in a single day. Or maybe it's $100,000 and you see it go down to $92,000 and mentally you're like, I need to sell this because I just lost $8,000 in a single day. But in reality, it's the same as if you put $100 in and it went down to 92. That's the same margin. That's the same difference. The volatility is exactly the same. You're just working with more money. And so some people have to start smaller before they actually get to those big accounts where you're investing a lot more money. So you want to invest, but you want to make sure you're comfortable with what you're investing and how you are investing. With the amount of money that's going into these investment accounts, you're going to want to make sure that you're comfortable mentally to actually be prepared to see those swings, because one day you might be down $100, and then the next day you might be up $300, and the next day you might be down $500. Sometimes those markets are very volatile, and you can see it every single day, just the swings and the ups and downs, and mentally people just aren't prepared for that. And so if you start a little bit smaller with what you are actually aware of, what you're capable, and what you actually mentally can prepare yourself for, then when you see those swings, you're not actually sitting there like, I need to buy or I need to sell because it's a good time to buy or a really good time to sell before the market goes down even further. You just want to be invested long-term in the market, watch those flows, you're investing long-term, and so you don't want to be dipping in and out of the markets or have that feeling that you need to because you see those big swings because you have so much money in the market at first before you're actually mentally prepared to see those things happen. And then as you see those nerves getting calmed down, as you're training those nerves to see what it's actually like, start putting more money in, start investing more money. And eventually it'll just become secondhand. Sometimes it'll be like, oh, I'm down $10,000. That's okay. It'll bounce back. It's in the long run. I'm not selling. I'm going to retire in 30 or 40 years. So it's okay to see that kind of stuff, but just make sure that you can actually mentally prepare and be stable enough to be okay with what you're actually seeing. The number 4 mistake that I see beginning investors make is that they're not investing enough. So maybe the third mistake where I said you're investing too much at first, maybe you get comfortable with just investing what you can, and you're investing maybe $50 a month. Awesome, that's cool. But eventually you're going to want to try to push those investments higher and higher and higher and higher so that you have longer time period in the markets to actually start snowballing and compounding so that your investments get a lot bigger faster, so that whenever you do go to retire, you have enough to actually retire. It's scary because most people retire and they don't have enough money to retire. They actually have to have a part-time job, or sometimes they have to have a full-time job because they weren't actually prepared to see that inflation ate that dollar value up at the same time that you were investing. And so, for example, if you have $50 today, that same $50 in 15 years will be worth $72.50. So your $50 actually grew $22.50. But you can only buy the exact same things you can buy today, meaning that the purchasing power of the dollar bill went down. And so if you have $50,000, that's the same as $72,500. It's all the same margin, but you can see that your purchasing power is actually way down, almost 50% of what that $50,000 would be worth today. So for example, let's look at a retirement plan 4% rule, meaning that if you were right now today saying, I want to retire in 15 years, let's say you can live off of $50,000, all expenses paid, all your bills are taken care of, your mortgage, everything, you can live off $50,000 per year. That means that in 15 years, you will have to have $72,500 to cover the same bills. Everything exactly the same. You will have to have $72,500. This is called the 4% rule, meaning that if you have all your money getting a 4% return, you can spend 4% every single year, and by the next year, that money will be back in your account. So if you do the 4% rule, you would take the $72,500, divide that by 0.04 or 4%, and you would actually get $1.8 million. That's how much you would need in order to live off of $72,500 following the 4% rule. Or another way you can do it is just take that amount that you think you can actually live off of every single year and you multiply that by 25, which would give the same thing of $1.8 million. Now, I know that not everyone's gonna need over $1 million. I know that. If you have $1 million, or even if you're less than $1 million, you can definitely make things work. It's just you want to follow the 4% rule because you want to be able to prepare for how much you think you will actually spend in the future when you retire. You don't want to get to retirement and then say, man, I don't have enough and I actually have to work a part-time job, if you don't want to have to actually work a part-time job. Or maybe it's a full-time job and you can never retire. You don't want to get to those spots, those positions in life, and then realize that you messed up. And if you would have just invested an extra $100, $200, $300, maybe $500 a month, then you would have been set off and been able to wake up every day in your home and not have to actually have a schedule to go to work, follow what your employer says. Maybe you're actually retired and you get to live life with your family and friends that are there around you. And so just make sure that you are investing enough. Like I said, start slow, ease into a little bit so that you can mentally prepare yourself for what your investment portfolios will look like as the markets are moving up and down. But that time period doesn't have to be very long. Some people, it only takes a week. They are in it for a week and then they say, okay, I know how this is going to look. Let me start investing a couple $100. Let me start investing. There's people that I've told this to and they start with $50 a month and all of a sudden it's month 2 and they're up to $500. And it's month 3 and they start seeing that thing grow and they're like, I want to invest $1,000. I want to invest $1,500. I want to invest whatever it is. They just keep growing and growing and growing. And it almost becomes like a game to see how fast you can make this account grow. And at the rate of speed that it grows, it is shocking because like I said, the markets are so volatile that there might be a day where you see your account go up $20,000 and it is mind blowing. Now it's not actually there because you haven't sold it. It's not actually yours. It's still in the market. But it's still awesome to see that all this hard work, your consistency on investing, your discipline on not buying crap that you don't need is actually working in preparing yourself for your future, for when you can retire, so that you can be where you want, when you want, how you want it to be in the future. The 5th mistake that I see beginning investors make is that they don't actually understand what account they're getting into. They want to invest, but they don't take into consideration that there's tax-free accounts where you actually contribute post-tax dollars. So a Roth IRA, for example, and that Roth IRA will actually grow tax-free, meaning that the amount that's in there, you get to withdraw at 58 or when you retire, and you actually get to withdraw that money tax-free. There's other accounts like a 401k or a traditional IRA where you actually get to contribute pre-tax dollars. And then when you pull that out when you retire, you pay taxes on that amount. Now, there's different philosophies, different reasonings on why people think which one is better. And I personally like to think of a 401k to max out that 401k with my employer, and then at the same time have a Roth IRA that I am contributing more to every single month on top of what's already going to that 401k. So then I have a 401k where I'm getting a guaranteed from my employer, for example, 100% match on every dollar that I put in up to a certain percent. And then I'm also contributing post-tax dollars, meaning that it'll grow tax-free in the long run. And so when I do retire, I'll have my 401k that I get to withdraw from and pay taxes on, and then I'll have my Roth IRA that I get to withdraw from tax-free, along with other benefits like maybe Social Security if it's there. I don't know if it'll be there, but those are just different paths and different ways that I plan to be able to pull money from when I do retire, so that I can live how I want when I actually get to that point. Now, if I get there, awesome. If not, I know that I'm setting my family and my future family up for generational wealth by investing into the future like I'm doing. Now, I promised you a bonus, and in this one, I'm just gonna put it straight out there. You need to focus on one asset. What I mean by this is people start going down all these different paths when they want to invest. I want to invest in ETFs, and I want to invest in index funds, and I want to invest in mutual funds, and I want to invest in cryptocurrencies, and I want to invest in individual stocks. There's all these different ways that you can actually start getting invested. But what I recommend is focus on one. If you don't know what one is, but you want to invest in that, you need to become an expert at that type of asset. So if you want to know what an index fund is and you want to invest in index funds, research it, watch videos. And in fact, I'll have a video right here that's actually going to go over what a mutual fund, ETF, and index fund is, the differences in what they actually are. But make sure that you're trying to focus and learn at the beginning of investing on what each type of asset you can actually invest in, and then become an expert, start investing, and then start dabbling in something else. You don't want to spread your mind too many ways to where you can't actually understand what you're investing in, or it's so hard to figure out and keep track of every little thing that you are investing in because you're spread out between all these different accounts or all these different investment types. And so that's my bonus tip. I'm Curtis Rylant. If you liked this video, go ahead and drop a like and subscribe for future content, because I'm going to be going over all things investments and personal finance. And down below, let me know, what is a mistake that you have made when you started investing? And if you haven't started investing, tell me why below. Maybe you're scared. Maybe you don't have the finances yet. Maybe you don't have that emergency fund. Whatever it is, down below in the comment section, tell me what that is. And if you want to reach out to me, it's rylant.curtis@gmail.com. For whatever reason, rylant.curtis@gmail.com. Remember, guys, you can do all things through him that give you strength. Peace.